guys, I am thrilled to welcome today's guests, Stephanie and Patrick here, clocking in straight from Philadelphia, home of the Eagles. Just like their hometown team, they know how to play offense and defense in the residential real estate market. Thank you guys so much for joining with us, and let's kick it off. Here we go. What's going on, guys?
Awesome. Thank you very much for having us. I appreciate it. Been working with you guys for quite a while now. Always a trusted partner working with Madison. So happy to kind of jump in, reach some of your clientele and teach you a little bit more about who we are, what we do, and real estate as a whole.
Perfect. Yep. As we know, real estate is one of the top 3 most popular investments here at Madison Trust. Self-directed IRA investors, they love to invest into residential real estate because it's tangible and income producing for properties, and it's a great alternative investment for these investors beyond traditional stocks and bonds. So I'd like to kick it off with some questions, and you guys just filter in however best you can answer them, okay?
Awesome.
So
That works for us.
perfect. So what is passive real estate investing with a self-directed IRA? And can you explain the differences between active and passive investing?
Yeah, sure. So a couple of things there. Investing through your self-directed IRA for real estate is a great opportunity to truly be passive. And what I mean by that is a lot of people in the general public perceive real estate investing as passive because it's not your W-2 traditional way of earning income, right? So the way that they generate a passive return is kind of the black and white way is you maybe purchase a property, you get tenants, they pay you a rental income, which then you pay, or it covers your mortgage payment, and then you keep the delta or the additional, which you would consider passive. Now, us at PPR, we consider that more active passive because you quickly will learn, and if any of you here are currently or were landlords at any point, there's certainly a lot more that goes into it than just simply collecting the rent check, right? So it could be from things like phone calls at night, from maybe flood, plumbing issues, electricity, whatever the case may be, headaches with the tenants themselves, struggling to pay the rent, and a laundry list of things of that nature. Where here at PPR, we're giving you the opportunity to invest in the same investment vehicles, staying in primary residential real estate, but then again, filtering it back to what we consider actually passive income, where you were giving us your capital for a defined amount of time. We are simply the ones dealing with the quote unquote headaches, whether that be dealing with tenants, the residential real estate itself, the properties, the issues that PPR handles that kind of protects you from not receiving those phone calls, headaches, not receiving rent checks on time. So again, we really define what passive income means when investing in real estate, where you truly are providing your capital for a defined amount of return. And again, not having those headaches in your day-to-day process.
Fantastic. Sorry, Stephanie, were you talking? I don't know if I jumped in on you.
Nope, you're all good. There might be some background noise from our other conference room. Sorry about that.
Got it. It's all good. Well, before we get into mortgage notes, I do want to talk a little bit more about, our disclaimer here at Madison Trust. We are a passive custodian. So although we have so many investment opportunities for clients to be able to invest into, we cannot recommend specific investments to our investors. We always encourage our clients to do their due diligence on the assets they choose to place within their self-directed IRA accounts. Another type of asset clients can hold within an IRA account is a form of a mortgage note. So Patrick or Stephanie, can you go into a little bit more about what is a mortgage note and what is a mortgage note in the context of PPR?
Yeah, definitely. I'll take that one. So mortgage notes, notes in general are one of the many avenues you can take in real estate to use your self-directed IRA to invest in. So, just like our car note that we might have, the mortgage is the debt on the physical home that a homeowner has sought out to purchase. They've, had their underwriting done, they had their loan originated. So, they're actively paying off their mortgage to, eventually own their home. Now there's a couple of different aspects of a mortgage note and things you can hold individually. As a self-directed IRA account holder, you can hold a performing note. So that's a note that, you've purchased from, a bank or an institution, and those mortgage payments are on time and everything's going fine in the mortgage. The other side of that, which you tend to pick up at more of a discount, would be a non-performing loan, a non-performing note, and which is what PPR specializes in. But those are those, mortgage holders, homeowners who have run on some sort of financial trouble, and therefore, they're not able to make their payments on their mortgage. So you can certainly do that individually with your self-directed IRA. However, there's a lot of compliance that goes into that. There's lots of, legal fees. There's lots of, again, more of an active passive investment than a truly passive investment would be. So in the context of PPR, a majority of our fund focuses on non-performing mortgage notes, which we, of course, can acquire at a discount. And then using, years of expertise and, many of our partnerships, we work to either modify the existing mortgage with the homeowner to get them back into a payment they're comfortable making, able to make, to get them back on track and into re-performing status. Or if we're not able to do that, we'll take the other option, which is exit through the property, via your traditional foreclosure or, deed in lieu process. But, that's another way, of holding that asset, a note, but you do it through a fund who does all the legwork for you as far as the compliance modifications and foreclosures, and you receive, the passive rate of return.
Wow, fantastic. I mean, just last year alone, we've helped so many investment sponsors raise so much capital through promissory note lending. It was one of the most popular investments last year, and I really see an uptick in that. So that's fantastic that PPR offers that for investors. Well, moving right along here. So what really are the risks of investing into your flagship fund?
Yep. So our flagship fund is 100% focused on residential real estate. So as I mentioned, we have the note space. So that's about 70% of our fund. The other component to our fund is strategic or opportunistic, as we call it, multifamily properties. So everything being residential real estate in general, we're of course, relying upon real estate values. So any large dips in nationwide real estate. I should mention that we are diversified across all 50 states, but a dip in nationwide real estate certainly affects our portfolio balance as a whole. But really the big indicator for our fund that we watch is the unemployment rate. So most people who have a mortgage, or especially if you're renting, you're likely, dependent upon your job, and not having a job with, small prospect of being able to get a new one certainly puts a damper on being able to modify a note. If, that's what we're working with in default, it's hard for people, to pay their rent. So those are, the two biggest health indicators, for our fund, the real estate market as a whole. And then of course, over high unemployment, that's high for too long. So those are, the larger indicators for the fund. Of course, interest rates, certainly play a part as well, both positively and negatively. But, the other component of unemployment is the bigger indicator.
Awesome. Can you walk us through two case studies of non-performing loans?
Yeah, I'll jump in there to kind of contribute to what Stephanie was referencing as far as what we're doing on the non-performing loan side. Because it's not a traditional way to invest in real estate, we really like to make sure we can show you exactly what we're doing or how you can actually exit the property via just, or I guess exit the property in two ways: via the homeowner themselves or the physical property, like Stephanie mentioned, in a foreclosure process. So again, to give you a little color on what we're doing with these non-performing loans, we're purchasing them. We're purchasing these non-performing residential mortgages, I like to always clarify, from these large banks, right, at a considerable discount. So to add color to that with this live example, the principal balance remaining on this primary residence was $106,000 and change. And then they were not paying their mortgage for 90 days plus or more. So we actually bought that $106,000 loan for $65,000 and change. What we were looking to do here is a loan modification to better fit the homeowners or borrowers of this loan, in which they can start paying again. And usually what the traditional bank in America will consider a reperforming loan is 12 months consecutive of paying a mortgage on time again. That's when a definition of a non-performing loan now becomes a reperforming loan, and it simply adds value. But that being said, as soon as a non-performing loan a homeowner starts paying, there's value created immediately. Obviously, because you're essentially holding a debt asset, there's no cash flow or no cash generating from this asset that you hold. To now, you're getting a monthly payment for the most basic example of the mortgage payment. Now they're paying again. So again, we bought this loan for $65,000, we'll call it, with the total loan that was left that the bank was holding, that the homeowners owed $106,000. We did a loan modification for the homeowners to start paying the mortgage again, and then we sold this exact loan for just over $78,000. So again, we bought it for $65,000. In the background here, working with the homeowners so they start paying their mortgage. Primarily, it's going to be they have, say, 15 years left on their mortgage. We move their mortgage back to a 30-year. Again, this is just a very plain black and white example to provide. But that would obviously lower the principal and interest because they're paying over a longer duration of time. And then we sold it again once they're paying for an extended period of time for $78,000. So our gross profit on this individual loan was $12,736 with our gross return at 28%. So the entire process for buy to sell took just about 7.5 months. And again, we took that from a non-performing loan to a reperforming loan, which we bought from a bank, and now it's reperforming, and then we sold it to a bank. Very commonly, we'll sell it back to the exact same bank that sold us the non-performing loan. For a lot of different reasons, they'll want that reperforming loan back because they may have even been forced to sell us the non-performing loan if they had a certain percentage of bad debt on the balance sheet. They might be forced to from regulations, or they're just looking to collect some capital back on some quote unquote not cash flowing assets. So again, this is your traditional how we profit on converting a non-performing loan to a reperforming loan. And then to give you one more example on the other side, again, we are traditionally exiting all of these non-performing loans in two ways: through the homeowner themselves, which you just saw on example one, where we're actually selling the loan back. The homeowners stay in the home, not much changes there. To now on the other side, if we cannot convert the non-performing loan to reperforming loans, this is an example of us foreclosing on the property via our exit. So the unpaid mortgage on this home was just over $1 million. We bought that loan of $1 million for we'll call it $322,000. We were not able to work with the homeowners. Maybe they were deflecting our contact, just saying they were not planning on paying, whatever the case may be. So we went into a foreclosure process with them. Once we foreclose on the property, which we are always first lien, so we do have full rights to the property, we sold the home at market value, which came in at $481,500. So our gross profit on this was $159,000 at 22%. This is standard that if you saw on the reperforming loan that was sold, the hold period in total was 7.5 months. On this one, it's showing 21 months. That is typical. The foreclosure process for us to make profit will, in general, be a longer duration of time before we collect our capital and return back versus the reperforming loan. And that being said, we do certainly prefer, and majority of our non-performing loans do convert to reperforming and then are sold. So it's about 75% of our non-performing loans converting to reperforming and then sold back to a bank. These are two very individual snapshots of what we're doing on the back end, but why it's very advantageous for you is this is example 1 and 2. We have right now, I think, over 4,000 non-performing and reperforming loans in this fund itself. So all of which are on different timelines, fully diversified. We do hold non-performing loans in all 50 states. So it's very advantageous for a homeowner as far as, or an investor as far as diversification, just to see what we're doing on a grand scope, because I'm showing you very individual scenarios. But again, there's a much bigger picture going on with all of these loans kind of in different processes and different ways we exit, things of that nature.
Awesome. And for those that are just tuning in, Patrick, can you just slide to slide number 2? I think we only got the first example.
Oh, is it not showing?
No. No, we have two examples here. That's
Two examples.
Yeah, the first one was the getting a loan to reperformance, and then the second slide is our foreclosure example.
Got it. Okay, perfect.
So are you seeing example one here?
Yeah, I only see example one, so I didn't know if anyone wanted to see example
Now
two.
are you seeing example two?
Nope.
Oh, really?
Sorry, that was our fault.
Here, let me see if I can just get out of, what about now? No.
To make it big again.
Oh,
Make the...
there it is. Example two.
Now I see it. Okay.
Sorry
So
about that.
I apologize. I thought it was showing on the screen. So just to reiterate, and I'll go through this just briefly. This is a way we exited the property via a foreclosure. So we bought the loan that still existed on the property for just over $1 million. We bought that $1 million loan for $322,000. The homeowners were not working with us for whatever reason. Maybe they weren't answering our calls, not willing to work with us, didn't have the funds to pay their mortgage. We foreclosed on the property and sold it at market value, which it was sold to another individual for $481,500. Our gross profit here is showing $159,000, and then our total return 22%. Like I mentioned before, this hold period, the full duration is 21 months, whereas on the not performing loan to reperforming loan side of then sold, it's about 7.5 months. So as I mentioned prior, a little bit longer duration of time as far as getting your capital back and your return on the foreclosure side versus going from not performing, reperforming, and then selling that reperforming loan. And then I'll stop share there.
Beautiful, beautiful.
Sorry about that. I think it was showing on the screen.
It's all good. I'm just happy we got those two examples now. I didn't want to interrupt you. You spoke for so eloquently. So just back to our questions here. What is your multifamily strategy in this fund?
Yep, I'll take that one. As Patrick was mentioning on the slideshow, diversification. So our fund, while we're mainly in the note space, and that 70% is 4,000 notes diversified by geography, any investor shouldn't have their eggs all in one basket, and we as a fund have to, do the same. So the next logical step in residential real estate would be multifamily. So what that means for PPR is investments in strategic and opportunistic multifamily, but as I mentioned earlier, not part of a buy hold strategy. So we don't, unlike, some people might be familiar with syndications or things where you get involved with maybe one property because you're, doing renovations or there's a project at hand, you're involved in one property. PPR is involved in 11 properties in total, all with different projects and outcomes for each property. So for instance, we have a ground up build of affordable housing that we did in Austin, Texas. Now, Austin, Texas itself doesn't specifically fit our buy box. We're usually in the Midwest because we work in the workforce housing sector. However, Austin itself has a huge need for affordable housing. So we went in with the opportunity to build affordable housing, to create some. The reason being is that those buildings carry huge value in their property tax abatement that comes in the future. So that was unique. We just got into a build to rent community in Knoxville, Tennessee. So that's addressing the millennial issue, renting for a little bit longer, but maybe the older millennials now have families or pets and they've kind of outgrown apartment living. So build to rent is becoming, an asset class that we're increasingly interested in because they're single family homes being built to rent out for longer terms, but to give more of the homeowner style of renting, again, to kind of address another need in the rental area. Similarly, we'll come in as a value add. So someone who, maybe we're in workforce housing, but the older units need some upgrades. So maybe we come in as capital partner to do renovations and kitchens and bathrooms, raise the overall, property value, maybe raise rents a little bit. But, you look to exit that way after you've added value. So that's the multifamily strategy. It's our diversifier. It allows us to contribute to our internal rate of return, which helps us pay our investors consistently and, keeps the portfolio sustainable for the foreseeable future.
Sure, sure. And definitely that diversification is helpful in today's market. We have, first-time home buyers who can't even try and purchase a home, so they've been stuck renting for quite some time. And you are correct, they're looking to build families and need more room to work from home or do that. So fantastic, Stephanie. We get this question a lot, and it is some taboo for investors, right? What is UBIT and when are you exposed to it? So I'd like to lead with just from a self-directed IRA perspective, and then I'd like to learn more about if PPR is exposed to UBIT, or the investments, I should say, are. UBIT really stands for unrelated business income tax. It applies when an IRA invests in something that's considered an active business instead of a passive investment. So for example, in very simple terms, if an IRA owned a bakery, the profits from selling goods could trigger UBIT. What we're curious to know is PPR investments exposed to UBIT, and how do you mitigate that for investors?
Yeah, great question. Short answers for anyone who's anxious to know, no, we do not expose you to UBIT if you were invested with PPR. We opened up we'll call it like a sister fund, which is called the Reliant Freedom Fund, to our flagship fund in 2022, I believe, to essentially protect those self-directed IRA investors. Today, I think it's over 35% of our investors are coming from self-directed IRA investments, just to show the importance and how fast it's growing. As a whole, I mean, because of alternative investing and things of that nature, self-directed IRAs are becoming much more popular on the scene. 10 years ago, it felt like a lot of people didn't even know they existed. And now it is certainly becoming more, maybe from people leaving their job to transferring that 401k to a self-directed IRA, things of that nature. So it was very important that we did so, or have an investment vehicle to protect them. So how PPR avoids making sure that you are exposed to the UBIT tax is you are investing in the Reliant Freedom Fund. And the flagship fund that we've spoken about with some of the investments and assets is in the Reliant Income Fund. So really what is happening is the Reliant Freedom Fund is set up as just a specialized tax vehicle. The Reliant Income Fund would essentially borrow money from the Reliant Freedom Fund of where your capital went into. So you put in $100,000 into the Reliant Freedom Fund. The Reliant Income Fund is not borrowing from that entity and using that capital for the investment against leverage or against the business, like Nicole said. So once we're filtering the capital distributions or profit back to Reliant Freedom Fund, you were technically not using or exposed to that business or leverage because it is a different entity that your capital was sitting in, quote unquote, but it wasn't directly impacted or invested into that investment type or vehicle. We simply knew that we had that capital and borrowed against it to invest in that investment. So again, in short, we just use a specialized tax vehicle entity to make sure that your capital is going in strictly there and not directly to the property investment, whatever the case may be, to protect you from UBIT tax.
Awesome. Our team definitely spends a lot of time in Austin. We have a strategic relationship with them. We love the food, don't like the traffic, but love the people. So a great place to diversify for your properties.
Thank you very much for having us. We do appreciate it. As always, Madison Trust is a great partner to work with. We always have great experiences with you and appreciate very much us being able to share some of our story and having us on.